You're listening to Fund Flow, a podcast for emerging managers offering insights into the journey of new and aspiring fund managers seeking to have access in a crowded market. Tune in as McGuire-Woods partner and host, Jon Finger, is joined by guests ranging from first-time fund managers to proven emerging managers, experienced LPs poised to back emerging managers, and other key participants in the emerging manager ecosystem. Hear their real-world perspectives and gain actionable tips to help inform your strategy and position yourself for a successful fund closing.
Welcome to Fund Flow, a podcast for emerging managers. I'm Jon Finger, and today I'm very excited to be joined by Owen and Raj, co-founders of Climate Core Capital. Owen, Raj, thanks so much for joining me today.
It's a pleasure. Thank you.
What I'd like to do in the first part of our conversation is delve into the research that led to the founding of Climate Core Capital, as well as some insights around climate data and how it's a truly difficult challenge for investors to accommodate and incorporate within their investment mandates. And maybe when we start here, Owen, let's spend some time with you and maybe tell the listeners more about yourself, Raj, your careers, and how the two of you met and led to the founding of Climate Core Capital.
Happy to, John. As the audience will tell from my accent, I'm Australian. I was a diplomat in the Australian government through my 20s, working on different international climate agreements and Antarctic treaty protocols. After a stint in business school, I went into real estate and family office services, but the burning kind of large global issues from my time in government stayed with me, and I had a chance to come back and do research at the Graduate School of Design at Harvard University here in Cambridge, Mass, where I still live. The work was really around what was going to happen to the built environment and specifically real estate prices when we could quantify climate risk better. That led to me working with some really world-class faculty on a data set that 280 cities in the United States above 100,000 people, and plotted them for both their physical climate risk, but also their climate readiness. And that's something that we'll probably delve into in future questions. In terms of how Raj and I met, funnily enough, we actually met through our wives. Raj had been working in real estate capital markets for much of his career, and I was working in prop tech in Europe at the time. And just like one of those dinners where you get invited along and your partner says to you, "Oh, you're going to love the husband you're sitting with," and it's almost never the case. Well, here we are 3-4 years on and partnered together in a large investment business.
That's great. I will tell you that is the first time I've heard that on Fund Flow. So I knew you guys were groundbreaking, but here we are. Well, that's fantastic. Let's talk about what led to establishing, I think it was in 2021, what led to establishing Climate Core Capital?
Yeah, I think when I talked about that data set, if you think about a scale of just say 0 to 5, with 5 being a large, high level of climate risk and 0.1 being the lowest level of physical climate risk that might exist in a location. Some of the underlying data that we were fortunate to partner with showed that on a scale like that, if you took any market from, say, 1 to 2 or 2 to 3 on this scale, it effectively meant there was a doubling of overall climate risk. And that led to a spectrum of all of America's cities. We often get asked, what is the worst market in our data set? Right now, when we combine physical climate risk and readiness, the data set that we see the greatest risk in allocating a dollar is Naples, Florida. But the best market is somewhere like Ann Arbor, Michigan. Now, intuitively to an American audience, it's probably understandable why one of those markets would be at one end of the spectrum and one at the other. A place like Ann Arbor, Michigan obviously has no sea level rise. No, it's not in a hurricane corridor. There's minimal wildfire risk. And even though they deal with fairly heavy winter storms, there is consistent precipitation. So we started to think about this idea of risk and readiness. And if the audience just imagines a simple 2x2, in one quadrant, you have places like Naples, Florida that are high risk and low readiness. And in the other quadrant, you have low risk and high readiness and markets like Ann Arbor. So it became fairly intuitive to us that there were going to be a lot of participants in the financial market that wanted to participate in different ways around the climate repricing. Another way to think about that is just a big climate short or a big climate long. A big climate short is actually a very difficult thing to execute. You have duration risk, you have assets responding on different timescales, and you rightly have the government intervening at numerous stages to backstop or bail out assets at risk because there are larger geopolitical or strategic reasons why places disrupted by climate hazard still need to be able to thrive and recover. The big climate long is a different story. It was clear to us from the data that there were parts of the country that were growing, that exhibited low risk and high readiness, but that had many different factors that led them to be a positive compounding experience in the years ahead. So it was going to make sense for more people to live in these locations than currently do. Growth was occurring in these markets for secular reasons unrelated to the climate. And the big climate long that Climate Core Capital identified was to aggregate high quality real estate assets in these markets.
That's great. Maybe talk a little bit more about your approach to identifying those lowest risk and highest readiness markets in the country for the fund to invest in.
Yeah, well, and I think a simple way is to continue with the Ann Arbor analogy. So as we talked about, when you think of risk and readiness as two different components, risk is really an aggregation of the science. So we are literate in the science, but we're by no means experts. So we take a group of different climate models showing different horizons between now and, say, 2040 to 2060. And, that's a combination of flood, heat, fire, hurricane, storms, and so forth. Now, the readiness is the part that perhaps other parts of the climate data world have not really thought as deeply about to this point. So when we talk about readiness, we're trying to quantify the extent to which any market in America is showing evidence of preemptive investment. Do they have natural advantages? Are there certain features or contours of the way that market operates, the industries, the characteristics and attributes there that lend itself to being able to absorb, accommodate, resist, and thrive alongside both disaster hazards and slow onset climate change at the same time? So when we think about that, if we think about it in terms of trying to find indicators of preemptive investment and preemptive defensiveness, that led to very obvious economic indicators like fiscal debt per resident. There's obvious things that we incorporate, such as number of homes, buildings, vehicles in the 100-year floodplain. But then we started to think differently around things like tree canopy ratios, urban imperviousness, perhaps unconventional markers that every single city possesses, but perhaps conventional real estate analytics had never thought that deeply about trying to capture at scale. So that has helped us to think differently about the capacity within which readiness might exist. And what we found was that there is a top quartile of markets in this country that exhibit very high readiness. They quite often exhibit low levels of risk. And again, to this idea of compounding, that climate change is really a story of positive and negative compounding in both directions. If we could find ways to aggregate real estate assets in the locations where compounding was occurring in a positive sense, that was going to be something that, other LPs, other investors further down the aggregation pipeline were going to be very interested in.
You touched on it a little bit. I'd like to get further into the core principles, tenets guiding Climate Core Capital, and maybe talk in turn around the cornerstones of your investment model.
Yeah, sure. We spent a lot of time around the academic data when the data set was being built. So there are fantastic faculty out there in different parts of the country working on floodplain, disaster responsiveness from a GDP perspective, lots of different markers, as well as, the different Federal Reserves in the country trying to do their own asset stress testing and experimentation of catastrophic and parametric bonds. All of this different work was going on around the financial system to try to think about creative ways to reprice and quantify climate risk. And I think being exposed to these ideas early on, it became apparent to us that climate disasters were going to reshape the attractiveness of locations in timescales that are just very hard for real estate investors to respond to. It was going to make divestment difficult. It was going to make repositioning difficult. And there was no guarantee in the most exposed markets that buyers were going to be there in the same numbers that they had in the past. So that was one realization. Another realization we had was that slow onset climate change. So when we talk about slow onset risk, we're thinking about extreme heat, water scarcity, sea level rise, the kind of mega droughts that we're seeing in the Colorado River at the moment, that these were going to lead to migration outflows that were probably going to be mostly visible in hindsight. So another simple way to think about that is there isn't going to be a survey filled out when someone leaves and becomes a climate migrant at the county line and they say, I left because of climate change. What's more likely is there's going to be school catchment rationalizations and grocery store closures and plants shutting down because very small levers of the financial system around the edges of what made an economy viable begin to change. Something that we try to press on investors in a first meeting is it doesn't take the big one, the big disaster in your market to reprice the assets. It simply takes the financial system recognizing the risk in a more systematic way. And finally, I think things that added and played a large role in the early design of the investment model was buildings designed for climate resilience and high readiness were going to carry a premium, and they have not been built, and capital has not been allocated to those assets at anywhere near the scale that the system requires. Another factor that feeds into that is we're probably heading into the first period of genuine energy price volatility that many of us have experienced in our lifetimes. And that is going to be a real consideration for landlords in the foreseeable future. So the extent to which you can have near net zero or DOE net zero ready, or even passive house buildings, we can talk about those terms in a moment. The extent to which those assets would perform in the future was really something that we didn't think was fully understood in the real estate orthodoxy. And lastly, it really does take time to accumulate, to actually build the technical competency of some of the design and construction characteristics we're describing. This isn't as simple as what LEED certified silver, gold, and platinum offered. The types of attributes and locations of the very best buildings in the future are going to be very different to what we currently understand them to be. And that's going to be reflected both in insurance and cost and availability of debt. We definitely see scenarios, and we've started to observe them in early exposure markets, where some locations are just experiencing a completely different insurance future compared to others. So I guess how I would summarize that is we're heading towards a very different experience for landlords and tenants. And as we move into a post-COVID world, there's a greater focus on interior air quality. There is a greater focus on the kind of quality amenities that people are going to look for, both from a disruption responsiveness, resilience, high quality airflow, sound. Many of these factors we just didn't see being captured in the way the best buildings are being valued now. And we thought that once we knew what we knew about where the best buildings should be, if we developed a technical competency to build them as well, that was going to match two very high points of competitive advantage together.
So you've talked some about it, but has this broader repricing of real estate started to happen? And if so, and I'm sure there's some, maybe talk about some more concrete examples of that and how that intersects with your focus for investing.
Certainly. There's a fabulous MIT paper that was just released in December. We'd be happy to distribute it in the notes by William Wheaton and the team there in the economics department. And they effectively took Class A and Class B offices in the Miami area and split them out into sea level rise exposed locations and non-sea level rise exposed locations. They then tried to study rents and also transaction prices. And there was a two-sided story that effectively unfolded with what they found. The first is that rents actually aren't moving that much at all. Tenants are not put off by being in a sea level rise exposed location. They're happy to still pay for the water views, and they cycle out in periods where, though they see marginal risk, it's not to the point where they don't still have a high willingness to pay for what we understand to be conventionally the best locations. The story was very different on the landlord side. Landlords have begun to price it from a futures perspective, capex, regulatory burdens, higher property taxes, higher insurance, and a restriction on mortgages, potentially contingent on dealing with different aspects of the climate risk of the specific site. And what the Wheaton research team effectively found was that 2 decades of Class A office value have been wiped from that market purely in the last 24 to 36 months. Such has been the desire of landlords to get out of some of these high sea level rise exposed locations. So any gains made between the year 2000 and now have effectively disappeared. A second piece of analysis was done by Rachel Meltzer at the New School, and that effectively looked at commercial establishments in Staten Island for the 7 years after Hurricane Sandy. Her results were really quite shocking. It effectively showed that revenue levels that existed prior to Hurricane Sandy did not return even 7 years after the storm if any of your block of small business establishments was touched by water during the storm. Such was the change in consumer activity, buying patterns, shopping routines, that people just simply don't come back to those locations anymore. And the last one I think worth sharing is some really scary stuff around depopulation from wildfire-ravaged areas of California. So a location like Paradise that experienced the Camp Fire in 2018, it was a population of 28,000 people on the morning of the fire. Its carrying population now is about 3,500. When you lose such a huge proportion of your population, it's these essential middle-class jobs around nursing, teaching, fire, municipal services. When those middle wage bracket occupations don't see a logic to come back to the location, it's very difficult for the place to function. And we're continuing to observe this in terms of vocation in wildfire recovery areas where the people are not moving back and the people you need to make the place work are not moving back.
That's really helpful, Owen, and I appreciate those insights. I want to, as this podcast is centered around the emerging manager struggles, observations, however you want to frame it, with the backdrop of how differentiated your fund is, I want to talk more now with Raj, and feel free to chime in, Owen, but talk about the capital raising, the LP relationship journey in more detail. So Raj, maybe let's talk about your background and the process of raising capital for a real estate emerging manager. And for examples, some of the strategies that you implemented to attract limited partners and family offices.
Yeah, sure. Happy to. And let me first apologize for the change in accent. I feel like your listeners just got a bait and switch on the listening pleasure of this thing. So my background, I've had about a 15-year career in real estate investment management and capital markets. Started in Chicago doing capital placement and advisory services for GPs and large fund managers. My wife and I then moved to Singapore for 5 years, where I worked for an Indian private equity real estate shop, and then kind of compelled by a lot of the frustration around how GPs and LPs connect and distribute information, I founded a small fintech platform focused on connecting larger LPs to deals that fit their strategic needs. I ran that for about 4 or 5 years, and it was then merged into a U.S. Real estate capital markets firm called RCX Capital Group, which moved us to London, where my focus was on, again, kind of advisory services, capital markets work, but also co-GP investing. Owen and I met. We started kind of, particularly during the pandemic, knocking around the question of what climate change means for real estate investors in particular, not just kind of these more macro questions of what it means for the built environment or urban environments. And we started honing in on crafting this strategy that sort of seeks to answer that question, meaning investors are in for a lot of changes when it comes to how real estate performs, how the allocation performs. And we sought to build a strategy that helps sort of course correct for that and allocate to locations and in a certain type of asset that helps mitigate the downsides of climate change in a real estate allocation, but also helps thrive alongside that. So, my background and career really led to, luckily, a strong understanding about how LPs operate, how the strata of LPs kind of differentiates between, the smaller, maybe less sophisticated, to the extremely large, more sophisticated. And I think that's something we've used to really structure our approach. We have a very differentiated strategy. We're very lucky in that. We're one of the only groups, if not the only group, sort of talking about bringing climate risk and climate readiness to the forefront of an investment product. So really, it's about identifying investors who are open-minded to our approach and then sort of meeting them where they are. Certain investors, whether it's conferences or thought leadership or direct engagements, they all operate in a different way. They all have their own processes. And unfortunately, it doesn't scale, right? The classic saying about a family office is, once you've met a family office, you've met one family office. It's a lot of idiosyncratic methods, a lot of different ways they think about allocating or they think about creating strategies. So